In today's video, we are going to be discussing all of the major earnings highlights over the past week. Earnings season has officially started, and I want to update you all with some of the key things that I found. The businesses that we are going to be discussing in this video are Visa, Tesla, Netflix, and Intel. These companies all reported some interesting results, so we are going to be diving into them. Before we get into the video though, I am very happy to announce that my book, The Fundamentals of Investing, is finished. I have my author's copy right here, and I'm going through the book one last time to make sure that everything is perfect, and then it will be available for sale. So it should be available within the next 2 weeks. I have also received some requests for signed copies from me, and the only way that I can think about doing this is if I order the books from Amazon, sign them, and then ship them out. So this would probably cost a lot more because I would essentially be double shipping the books and I would have to figure that all out. So send me an email over at daniel@stockunlock.com if you would be interested in getting a signed copy of my book. Because if there is a lot of demand for signed copies of my book, then it is something that I would consider and really try to figure out. So again, send me an email at daniel@stockunlock.com if you are interested in a signed copy of my book when it is available. Now, with that being said, let's hop into the video. And here we are taking a look at Visa. Now, Visa has been performing incredibly well, and the stock is actually right near all-time highs. However, it did drop about 1.6% after earnings, which is nothing when you really take a look at the grand scheme of things. But overall, it does look like the market wasn't over optimistic or overly impressed with Visa's results. So what went on here? Well, if we head over to Visa's earnings presentation, we can see that the revenue did grow by about 9% year over year, and the diluted earnings per share grew by about 10%. So the business is still growing, but this is definitely not as fast as the business has been historically growing. And it does look like the business is kind of going through a slowdown right now. I actually haven't seen a quarter where Visa posted under 10% growth to revenue in quite some time. So it looks like the business's revenue is starting to slow down. Now, this next screenshot shows us a little bit more data. We can see the revenue, the earnings per share once again, but we can also see the payments volume. Payments volume increased by 8% year over year, cross-border volume increased by 6%, and overall transactions increased by about 9%. So it looks like people are still spending more money, and they're not really slowing down how much money they're spending on Visa's platform, and things are still growing. But again, things are not growing as quickly as they have been in the past. Now here we can also see the 2023 to 2024 US payments volume growth. And we can clearly see that the payments volume growth is slowing down. In fact, in January, it's now hovering below 4%. And you can see that the trend is clearly going down. So it looks like people are starting to spend less money, and maybe the overall payment space is starting to slow down its growth. Now here we can see Visa's free cash flow, and this was kind of interesting to me because its free cash flow is $3.3 billion on this quarter. This is actually about $1 billion below their fourth quarter or their first quarter. That's how they report their first quarter 2023 results. So free cash flow actually declined by about 30% year over year, despite revenues growing. That is something that I would probably take a deeper look into, and could be a reason why the market wasn't buying up Visa stock more after they reported earnings. What's also interesting is they spent $3.3 billion on share repurchasing, so the entire free cash flow went to share repurchasing, and then they also paid about $1 billion of dividends. So Visa actually spent more money paying dividends and buying back shares than they generated in free cash flow, which is just something that I thought was interesting, because it means that they're dipping into their cash position to start paying dividends and buy back all of the shares that they're buying back, which isn't a red flag because Visa is cash rich, but just know that they are starting to dip into their cash position to buy back more shares. Visa then gives us their outlook for the second quarter of 2024 and the full year of 2024. So in the next quarter, they are expecting single-digit revenue growth and diluted earnings per share growth in the high teens, which is interesting. And then for the full year, they are expecting low double-digit revenue growth. So they look like they may be expecting revenue growth to start kicking up again for the rest of 2024, and then earnings per share growth in the low teens again. So the business does look like it is still projecting to grow over the next year. So if we head over to Visa here on Stock Unlock and we take a look at the business's price to free cash flow, and we compare it to the company's historical average over the past decade, we can see that it has been about 30 on average, and today it is about 27.8. I understand that this business is still selling below its historical average price ratios, but it is still a more expensive business in my opinion. It is still selling for about 28 times cash flow while growing revenue at about 9 to 10% annually, which is a pretty high price ratio for that amount of growth. So personally, I am not going to be buying a Visa here. because I think that there are better investment opportunities out there in the market. However, Visa is an incredibly strong business. For example, it has a stock unlock insight score right here of 4.24, which is very high. I don't typically see stocks with that high of scores. It's a very profitable business. It's a very shareholder friendly, and it's a high quality business. So this is definitely one that I am always watching, and it is one that I would love to add to my portfolio one day if the price does become attractive enough for me. But that is my overall thoughts on Visa's stock today, as well as its most recent earnings report. So the next stock that we are going to talk about in today's video is Tesla. And yes, I am going to be talking about Tesla. I don't talk about the stock too much on my channel, but this is a stock that has been requested a lot by my audience. Before we dive into this stock right here, I want to give a disclaimer that I am not the most well-versed person on Tesla. This is a stock that is heavily covered on YouTube, so you can probably get some more educated opinions on YouTube about the actual business, what its future products are, etc., etc. It's not really a business that I follow in all honesty. So what I am going to do is I'm going to dive into the financials and what the numbers look like and give you my opinion on the price of the business today relative to its growth and cash flows and everything like that. That's what I think I am very good at, so that's what I'm going to stick to in this video. So if we take a look here, Tesla has actually had a very rough month, and I believe that it dropped something like 12% after its earnings report. In fact, the stock is down about 30% over just the past month alone. So again, they are having a rough month. Now, I went through Tesla's earnings report and I found some of the highlights right here. So this says, in 2023, we delivered over 1.2 million Model Ys, making it the best-selling vehicle of any kind globally. For a long time, many doubted the viability of EVs. Today, the best-selling vehicle on the planet is an EV. So the best-selling vehicle in 2023 was the Tesla Model Y. I do think that is very impressive. Also, free cash flow remains strong in 2023 at $4.4 billion. So the company is actually generating billions of dollars of free cash flow, which is a good thing to see because it means they're making money. They're not in any financial stress and they're going to be just fine. Like Tesla is not going out of business, everyone, okay? It's just a matter to me of, is the business valuable and is the business cheap and offering a good risk reward opportunity for me? I think it's a high quality business. It's all just about what price do I want to pay for it. So if we move on, we can see right here that the total automotive revenues for the fourth quarter only increased by 1% year over year. Again, I don't really follow Tesla, but I thought that this was quite shocking. 1% year over year revenue growth to its automotives business. That's not really exciting, especially for a stock that is said to be growing its business at 50% annually. Yeah, I think that this is probably one of the reasons why the market did not respond nicely to Tesla stock after its earnings. The energy generation and storage revenue did grow by 10%. That's good to see. Services and other revenue grew by 27%. That's actually very good to see. Total revenues grew by 3% year over year. Still not that exciting. Gross profits also declined by 23% year over year, and income from operations declined by 47%. So the business's expenses look like they are growing, while the revenue is not really growing. It's honestly been kind of flat year over year, which is not that great to see for me. Operating cash flow grew by 33%, and free cash flow grew by 45%. And the business has $29 billion of cash. That's a lot of cash. So that's what I mean. This business is cash rich. They're generating $4 billion of cash per year. So they're not going to go out of business. Like Tesla's not going anywhere. It's all just a matter of how much do I want to pay for it. Now, this is the full year summary right here. So we can see that for the full year of 2023, revenue grew by 15%, which is much better. But it also suggests that Tesla's revenue growth is slowing down, especially in the fourth quarter. So it looks like they had a strong beginning of the year, but now in the fourth quarter, things are really starting to slow down for the business. Energy generation grew by 54% year over year, and services grew by 37%. Total revenues were up 19% year over year, but gross profit was still down 15%. Operating income was down 35%. Operating cash flow for the full year also declined by 10%, and free cash flow for the full year declined by 42%. So some really interesting numbers here. And overall, it does look like the business's revenue is growing still, but its profitability is actually declining. Now here we can see the market share of Tesla vehicles by region, and in every market, they are still growing their market share. It looks like in Europe, they are having a little bit harder of a time growing their market share, as it has been kind of flat for about the past year, but in US and Canada and in China, market share is still uptrending and growing. That is good to see. Energy storage deployments is also growing significantly. It is absolutely exploding. So Tesla's other segments of the business are still growing very strong, and I actually do quite like to see this. So let's head back over to Stock Unlock and take a look at Tesla's quarterly revenue over time. So we can see that it is overall uptrending, but we can see that for about the past 6 quarters now, the revenue has kind of been flatlining. So Tesla's revenue is definitely in a little bit of a slowdown right now. However, it's also worth noting that this is not the first time that this has happened. For example, take a look at this period right here from about 2018, the third quarter of 2018, to about the second quarter of 2020. Revenue didn't really grow over that 2-year period, and then revenue started exploding. So maybe the argument right now is that Tesla is in another little bit of a slowdown to its revenue while it is building out and delivering on other products. The company very well could just be in another one of those periods, and then maybe we'll see revenue start to explode again here in the next year or two. But the company is definitely going through a slowdown right now. If we also take a look at the company's operating cash flow, in the trailing 12 months, we can see that it has been coming down for about 1.5 years now. So its profitability has actually been declining. Now, if we go and take a look at Tesla's price to operating cash flow, it's been a little bit more of a consistent metric for the business. We can see that it is still selling for about 44 times operating cash flow. Now, in my opinion, this is still a very high price tag to pay for the business, especially if it is seeing headwinds and an overall slowdown right now. I think that a 44 price to operating cash flow for a business that is growing its revenue at 15% year over year, again, is just a very high price tag to pay for a business. So I would want to see this come down significantly before I start to become interested in Tesla. Also, it is worth noting that the last time Tesla's business was entering a slowdown from 2018 to 2020, it was trading for a price to operating cash flow of around 20, which is about half of what the company is trading for today. So the last time Tesla saw a period like this, the stock was about half of the value based on operating cash flows. So for me, I do agree that Tesla is a high quality business. I just think that it is on the more expensive and risky end right now. And basically, if an investor is paying this price ratio for Tesla today, then they have to have a strong conviction that the business is going to start seeing rapid growth again at some point in the future. That is up to the individual investor. For me, I am not as confident in Tesla's business or in my own analysis of its business to have that conviction that it is going to grow its revenues at 50% annually over the long term, because that is kind of what the stock is pricing in my opinion. So since I am not confident or have conviction in that, it is not a stock that I want to buy at this price ratio. Although there may be investors who believe the business is going to do that and have a much stronger confidence and conviction in the business, so they may look at this price ratio and think it's sane. I don't. I would want a much larger margin of safety for myself. So for me, Tesla is not quite attractive quite yet. If it continues falling, it would get to an area where I would want to buy it. At the moment, I don't know where that area is. I would have to do more research and analysis and DCFs and whatever. But at the moment, it's not a stock that I am currently interested in, and I would want it to drop significantly before I became interested in it. All right, the next stock that we are going to take a look at is Netflix, because Netflix stock popped roughly, it's up 17% since it reported its earnings now. And the company actually did report some pretty dang strong results. So let's take a look here. This table is the key metrics from Netflix's Q4 2023 report. And we can see that the revenue was about $8.8 billion right here, which is year-over-year growth of 12.5%. Now, this is a re-acceleration of Netflix's business. If we take a look at the year-over-year revenue growth from the fourth quarter to the fourth quarter of 2023 over the past year, it's been about 1.9%, 3.7%, 2.7%, and now it has shot up to 12.5%. So the business went through a little bit of a lull, but now it is starting to see its revenue re-accelerate, and this is a great thing to see for its shareholders. I'm not a shareholder, but for its shareholders, it is great to see that this is happening. The company is also expecting revenue growth to continue accelerating. In the first quarter of 2024, they are expecting 13.2% revenue growth, which is a great thing to see. So revenue growth is still continuing to grow. Operating income for the first quarter or next quarter is also projected to be 2.4 billion, which is a significant increase. And the operating margin is projected to be 26%, which is 10% higher than the fourth quarter of 2023. So they're expecting their efficiency to grow massively. Global streaming paid memberships also grew to 260 million, which is year-over-year growth of 12.8%, which is good to see. Netflix added 13 million people in this quarter alone. So the business is getting things back on track. There was a period there where people were not confident that Netflix was going to be able to continue growing its subscriber base at a high growth rate and its revenue at a high growth rate. Netflix seems to be proving people wrong, and they are doing so now. On the monetization front, Netflix said this: Scaling our ads business represents an opportunity to tap into significant new revenue and profit pools over the medium and longer term. In Q4 23, like the quarter before, our ads membership increased by nearly 70% quarter over quarter. So their ads business seems to be growing quite significantly and quite strong. Phasing out our basic plan for new and rejoining members in our ads market, the ads plan now makes up 40% of all Netflix signups in our ads markets, and we're looking to retire our basic plan in some of our ads countries, starting with Canada and the UK. So Netflix is getting rid of its basic plan now, and they are going to only have their ads plan. And it looks like the reason why is because their ads business is actually growing quite significantly. And, you know, maybe that's a fair play on the business. Now, if we go and take a look at their income statement right here, we can see that the revenue growth is once again starting to accelerate. You can really see that right here visually on this chart. If we also take a look at the quarterly revenue growth, we can see that it did go through a little bit of a lull right here in 2022, but now it is starting to re-accelerate, and that is a great thing to see. Now, what's really interesting to take a look at here is the company's operating cash flow. Take a look at the trailing 12 months, because basically this business never really produced any strong cash flows or operating cash flows or anything like that. And then it started freaking exploding. And now in the trailing 12 months, they've generated over $7 billion in operating cash flow. So this business is now generating billions of dollars in cash flow. It's very profitable, and that is a great thing to see. Its revenue is also starting to re-accelerate. So then my question always becomes, okay, well, what is the price of this business today? And I want to know, is it an opportunity today or really just what is going on? So let's take a look at Netflix's price to free cash flow right here. Let's just take a little bit of a look. So Netflix is selling for a price to free cash flow of 36.5 today, which in my opinion is actually quite expensive. You're going to see that this is the theme on my channel right now, especially while the market is hitting all-time highs and business price ratios have been expanding for the past 18 months or so now. The reality is there's not a lot of cheap stocks in the market anymore. So unfortunately, there's not a lot to do, especially for me as an investor trying to look for value in the markets. And Netflix is just another case of that. The stock is trading for a price to free cash flow of 36.5. I do not think that this is cheap for a business growing its revenue at about 13% annually. And it's just not really offering that much of an attractive return, in my opinion, at its current price. And I'll kind of explain why. So if we go to a business like Equitable Bank, which is a business that I am still adding to and buying shares of whenever I can, and we take a look at its price to earnings ratio, we can see that this business is trading for an 8.4 price to earnings ratio today, okay? That is about a quarter of that. It's actually less than a quarter of what Netflix is trading for today. However, if we take a look at the revenue growth of Netflix versus Equitable Bank over the past about 5 years since 2019, here we can see that Equitable Bank has been compounding its revenue at about 27% annually versus Netflix is about 15% annually. And Equitable Bank is trading for about 1/4 the price. So when I am looking at investments like Netflix, I try to compare them to everything that I already own and the world of investable opportunities out there. And when I see Equitable Bank, I'm seeing a business trading for a quarter of the price and growing its revenue almost twice as quickly. I think that there are stocks out there that are simply offering much more value than a stock like Netflix today. And that is why I am not buying businesses like this with high price ratios and good revenue growth, but not incredible revenue growth. So I just think that there are better opportunities out there. Netflix had a great quarter though. And if the business was cheaper, maybe I would consider it, but at its current price, I do not think that it is really offering a margin of safety or amazing forward returns from this point. Now let's move on to the fourth and final stock that we are going to talk about in this video, which is Intel, because Intel is down roughly 12% today and actually had a pretty significant drop after it reported its earnings. Now, to put things in perspective, Intel is up quite significantly from its lows here. It's up about 97%. So the stock did drop today, but over the past year, it is still up quite significantly. But let's take a look at why the market maybe was not so thrilled with Intel's report here. So right away, we can see that for the fourth quarter, Intel's revenue was 15.4 billion, which was up 10% year over year. So the company actually did grow its revenue by 10% year over year, and the business does seem to be overall growing. So that is actually a good thing to see. However, when we dive into where Intel's revenue segments are coming from, or where Intel's revenue growth is coming from, it kind of tells a little bit of a different story opposed to what the overall market theme is today. Here we can see that Intel's desktop revenue grew by about $600 million. Then its notebook revenue saw strong revenue growth of about $1.7 billion year over year, or about $1.6 billion. Sorry about that. So its desktop and notebook revenue are growing quite strong. And this seems to be where the revenue growth for the business is actually coming from. Now, when we take a look at data center and AI, its revenue dropped by about 10% year over year. This does not really sit well with the overall market right now because, in my opinion, we are entering an AI bubble. So everything AI is good. The market loves everything AI. If you got good AI right now, let's freaking go, right? So if Intel's AI segment of the business is not seeing growth, then the market is going to punish the company for that. So even though the overall business's revenue is growing, the fact that its data center and AI revenue is not growing is a big red flag, especially when you have businesses like NVIDIA and AMD seeing strong data center and AI growth. Because what this overall means is Intel is losing AI market share to NVIDIA and to AMD. And these are the segments of the business right now that the market probably cares about most. It basically just means that Intel is not as competitive as NVIDIA and AMD, and those businesses are stealing a lot of market share from Intel. So in my opinion, that is kind of why the stock is down. And here we can see visual representation. Its data center and AI group revenue was down about $400 million or about 10% year over year. Now, additionally, if we head over to Intel's cash flow statement, we can see that its operating cash flow is down by about $4 billion year over year, which is about a 30% drop. So that's pretty significant. Its capex was also about $26 billion for the year, which is up about $1 billion year over year, and also means that this business is still losing money. It's actually losing about $14 billion in free cash flow on an annual basis right now. So the company's operating cash flow is declining at the same time as its capex is going up, which means its free cash flow is dropping. And again, it's got about negative $14 billion of free cash flow now. So let's go and take a look at the business's financials here really quick. Let's take a look at its long-term income statement trends. And here we can see that Intel's revenue has been declining significantly since about the fourth quarter of 2021. So this business's revenue has been dropping quite a bit. Also, if we take a look at its cash flow, its operating cash flow, it's been cut in half over the past about 4 years now. So that is not really great to see either. Now, if we take a look at the company's free cash flow, you can see right here that it is negative. And again, this is because the operating cash flow has came down at the same time as capex is growing, which results in the business actually being unprofitable. So Intel is losing money right now. And then I ask myself, okay, well then how is the business staying in business? What is it doing to fund itself? And the answer is the business is taking on debt. In the last year, it has took on about $10 billion of debt now, and it has diluted about $3 billion of stock. So that is how the company is staying in business and affording to run itself right now, as it's taking on debt and it's doing dilution. We can also see that the company has an insight score here on stock on a lock of only 2. And if we take a look, there's a lot of bad things here. There's a lot of red flags. Dividends is bad. They cut their dividend. Financial health is only 2.8. Its growth is low at 2.1 because its revenue, gross profit, operating income, net income are all decreasing. Its profitability is also a 1.67. It's got an okay gross margin, but its operating margin, net margin, free cash flow margin are all negative. The business is unprofitable and it's losing money. The management score is also 1. So stock-based compensation as a percent of revenue is 6%. Stock-based compensation as a percent of operating cash flow is 22%, which is very bad. And the company is not investing its money very well at all. So there's a lot of red flags here when you actually take a look at the fundamentals of the business. So for me, I'm not really interested in Intel right now, especially at its price of $44 after the stock is already up 100% over the past year. I'm really just not that excited about it, you know? Revenue has been declining. It looks like the company is losing market share in its key markets, and its cash flows are negative right now. Its free cash flows are negative, and its operating cash flows have been declining. So there's really not a lot to love about this business, in my opinion. And it's not really a high quality business, again, in my opinion. So it's one that I'm going to avoid. It's not one that I would feel comfortable with in my portfolio. And it's not one that I'm looking to add, even though it's down 12% on the day. So that is my opinions and all of the highlights that I found with Visa, Tesla, Netflix, and Intel, and kind of my thoughts on their valuations today. If you did enjoy this video, then please remember to leave a like on it. And I will be doing a similar video next week for the major earnings that are coming out. So if you want to stay tuned and see that video, then also make sure to subscribe to my channel. And that would be pretty cool as well. Also, do not forget, if you are interested in my book, The Fundamentals of Investing, then it will be available probably within the next 2 weeks, depending on what Amazon does. And also, if you do want a signed author's copy from me, then send me an email at daniel@stockunalock.com. Let me know that that is something that you would be interested in. And then I can gauge the overall interest in getting signed copies to you. And then I can start figuring out how to do that and the price of getting signed copies to my audience. So again, send me an email at daniel@stockunlock.com, and I will potentially send you a signed copy of my book. But thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video. Have a great weekend, everyone.